Okay, welcome back to another lesson. In this video, you are going to look at a question that was tested in April 2023, and we are going to look at question number 5. That is a question on taxation for ATD students. Now, the question reads, explain the following classification of taxes. We need to know what are direct taxes. Direct taxes. When you're talking about something direct, something that you don't need a third party to pay. You are the same person who pay that. So in this case, we are saying that this is a system of taxation. This is a system of taxation whereby taxpayer remits tax to the tax authority personally. Remit tax to the tax authority. Personally. In other words, you are saying that it is a tax. It is a tax where the incident and the impact is the same person. Is a tax whose impact and incidence is on the same person. And cannot be shifted. You can't make someone else pay the same tax. So that is it about direct taxes. Indirect now is the opposite of what we are saying. This is a tax. This is a tax levied. It's a tax levied. It's a tax levied on something. Tax levied on something and paid by another person and paid by individual by virtue of their association with that item. By virtue of association with that item. Here, the impact and the incident is on different people. The impact is on one person, and the incidence on another person. E.g. VAT. VAT is an example of indirect tax. You pay tax without your knowledge. I hope it's clear up that point. Now, we move to the next question. Here you are told propose two ways. Tax avoidance could be engaged by an employed person. You see, tax avoidance is different from tax evasion. If you're very smart in tax laws, you can avoid taxes. And that is what we're saying. It's not an offense to avoid tax. You need to learn the tax laws of a country. Then you see how can you avoid paying some of these taxes. Now, as an employed person, there are better ways you can approach. A better way you can avoid paying taxes. Just a minute. I want, yes, you see this thing of mine head hang. Now, let's see what are better ways you can avoid paying taxes. One is by claiming reliefs. Claiming reliefs. When you have too many reliefs, you'll end up paying very little tax. Reliefs, e.g., we have personal relief, we have disability relief, you have insurance reliefs, yeah. This kind of reliefs, double taxation relief, etc. By having this, you'll end up paying very little tax. If you invest in interest on post banks, if you have savings with post banks and tax reserve certificates, in this case, you'll end up, if you're an employee and you invest in foreign countries, so those are some of the ways you can avoid paying taxes. Next, you are told that Kefa and Kennedy are partners, trading as Ken traders and sharing profit and loss in the ratio of 2:1. The statement of profit or loss for the year ended that 1st December 2022 reflected the following. We have gross profit, advertisement, we have depreciation, repair and maintenance, rent and rates, legal fees, value-added tax, general reserve, insurance premium, salaries and wages, interest on capital, bad debts, PAE penalty, purchases furniture, goodwill written off, donation to political party, custom duty paid, reported net profit. Then additional information, parking fines, settling dispute with customers, securing the bank overdraft, appeal on tax assessment. We have salaries to Kefa and Kennedy. Insurance premium included 116,380 paid to insure Kennedy private car. General expenses. Now, we are supposed to compute taxable profit on loss of the partnership for the year ended, and then we do allocation of profit. Good. Now, let's look at this one. You see this one, Ken. Is it Ken? Ken, or is Ken? It is Ken. It is. This is Ken Traders. This is the name of the business. Computation of adjusted taxable income for the period ending 31st December 2022. Here you begin with reported net profit. What profit did they report? These are partners, by the way. You are dealing the question on partners. So reported net profit. If you look at the question, they have a reported net profit of 9,113,390. Reported net profit is 9,113,390. 9,113,000, then 390. We add back. We adding back non-allowable expenses. Non-allowable expenses. Those expenses that were recorded as expenses, but they are not allowed. Let me go back to additional information. Let me show you what kind of expenses you are not going to allow. Parking fines, they are not allowed. Breach of laws, this is not allowed. Settling dispute with the customer is allowed. Securing a bank overdraft, you pay that legal fee, that is allowed. Appeal on tax assessment is not allowed. Appeal on tax assessment is not allowed. Salaries paid to Kefa and Kennedy. These salaries to partners, this is not allowable expenses. Because the business, they are going to share profit. So this one is not allowed unless they are employees of the business. But if they are the partners, no, they are not allowed. Insurance paid to expense of a private car, not allowed. This insurance expense is not allowed for Kennedy private car. Partners end year party is not a business to mind about their party. So that is not allowed. Partners end year party is not allowed. Embezzlement by cashier. When the cashier in car misuse money, you can't claim that is an expense. That one is not allowed. Staff catering, that is allowed. They are helping running the business. Foreign exchange losses, realize that is allowed. Preparation for tender document, those are allowed documents. We are told that 70% of bad debts are represented by general provision. No, we don't allow general bad debts. We only allow specific bad debts. So 70% of bad debts are general, so it is allowed. Capital allowances, that is allowed. Half of the rent paid by, this one, rent is paid to Kefa, who is a partner. It's an income to Kefa, but it's not allowed expense. It's not allowed expense, but it's an income to Kefa. Included in gross profit is shillings 495. Included in gross profit is 490, being profit on sale of motor vehicle. This is a non-business income. Now let's add back those non-allowable submission. Now this is additional information. When you go to, we'll go to the income statement. Let me mention some of the things that are not allowed. Depreciation, not allowed. Value added tax, not allowed. Value added tax and custom duties are not allowable expenses. Interest on capital, that's okay. Bad debts pay penalty, this is not allowed. You can't fail to pay your pay, then you claim it's an expense. Purchase of furniture is not allowed. It's not an expense. It's not allowable expense. Goodwill written off, that's not allowed. Donation to political party, not allowed. Custom duty, not allowed. So we are going to add back all those things I mentioned here that they're not allowed. We add them back to. So the first thing I mentioned there was parking fines. Parking fines, you breach the law, you can't claim that as an expense. Parking fines, 61,640. Appeal on tax assessment. Appeal on tax assessment is not allowable. 155,668. Then I've also said that salaries to partners. Salaries. You have Kefa who was paid 1,161,200. It's not allowed. We have Kennedy who was paid 1,322,400. Not allowed. Insurance paid to Kennedy private car is not allowed. Insurance Kennedy private car Kennedy, private car. That insurance of 116,380. Let me take you back there. We had here this one, insurance premium, this one, 116,380 is not allowed. Then we have partners and year party. Partners and year party. This is not allowed. Partners and year party, 89,000. Then we have embezzlement by cashier. Embezzlement by cashier. This one is not allowed. 45,652. You don't allow those kind of expenses. General bad debts. Remember the statement here. General bad debts were 70% of the bad debts. So general bad debts are not allowed. General bad debts. General bad debts, you take 70% of this is, I had calculated this one. When talking about general bad debts here, we're talking about this 70% of the bad debts. So you come here and look at where are my bad debts here. Take 70% of this. They are general, so they are not allowed. We move on. We have general bad debts. I've mentioned that rent paid to KEFA. Rent paid to KEFA. Paid to KEFA. This one is an income to KEFA. 475,350. Depreciation, I said depreciation does not involve the movement of cash. Depreciation is 2,193,600. Let me confirm depreciation here. Depreciation here, 2,193,600, correct. Higher. We move on. We have value added tax. Value added tax. Value added tax. 724,960. It's not allowed. Pay penalties. Pay penalties. Pay penalties of 221,320. Not allowed. Pay penalties not allowed. Purchase of furniture. That is not a business expenses. Purchase of furniture. These are assets. When you record assets, they affect your capital, not expenses. Purchase of furniture, 362,400. Purchase of furniture, we have goodwill written off. Goodwill written off. Goodwill written off, 146,640. Donation to political party. You don't allow that. Donation to political party. Donation to political party, 132,350. 132,350. And finally, we have custom duty. Custom duty. Custom duty paid 1,204,000. Now, I had pointed out this in this statement here. All this custom duty donation, 132,350. All these are not allowed with expense. Now, let's add them back. Let me bring them here. We have 61,640 plus 155,668 plus 1161,200 plus 1,322,400 plus 116,380 plus 89,000 plus 45,652 plus 361,648 plus 475,350 plus 2,193,600 plus 724,960 plus 221,320 plus 362,400 plus 132, no, 360, this is plus 146,640 plus 132,350 plus 1,204,000. So 8, this I'm bringing back this here. So I'm going to have 8,774,208. I bring them back here and I have adjusted net profit. Adjusted net profit. Adjusted net profit, add to reported net profit plus 9,113,390. Adjusted net profit will be this is 17,887,598. We less non-taxable income. We less non-taxable income. Less non-taxable income. Non-taxable income, here we have gain on sale of motor vehicle. Gain on sale of motor vehicle. There is no movement on cash here. This is 498,000. They don't tax this. Minus 498,000. We have 17,389,000. 389,598. Is there allowable expense? Yes, we have capital allowance. We have capital allowance. So less allowable expense. Allowable expense. This is expense that should be deducted. If you look at the additional information here, you are told that capital allowance were agreed to be 2,522,000. So less capital allowance. We have capital allowance. What are capital allowances? This is 2,522,000. These are allowances on investment that take long to start operation. Minus 2,522,000. This gives me 14,867,598. Good. That is now the profit that the partnership made. What did KEFA get? The profit sharing ratio was 2:1. So KEFA, share of profit. Share of profit. Share of profit. Here we have KEFA and then we have Kennedy. If you look at the statement here, you are told that Kefa and Kennedy are sharing the ratio of 2:1 respectively. So Kefa is getting 2, Kennedy is getting 1. So Kefa is 2/3 as an 2/3 times 14,867, 598 times 2 divided by 3. This is, you get, this is 9,911,732. Kennedy is 1/3 times 14,867, 598. So this is 14,867, 598 divided by 3. This is 4,955,866. When you add these two plus 9,911,732, when you add these two, you'll find correct answer, which is 14,867, 598. We look at allocation of profit and loss. Now, here I will look at, I will work on appropriation. How do they appropriate their allocation of profit? Allocation of profits. Here, okay, I've allocated profits here, but I want to show you what we call, we want to see their taxable income here. I want to help you get the taxable income. We have Kenny, we have Kefa, sorry. We have Kefa and then we have Kennedy. We have Kefa and then we have Kennedy. Now, first of all, there was interest on capital. That was an income to them, interest on capital. Kefa got 763,800. Kennedy got 784,600. Then there were salaries. Salaries, this one gone to 1,161,200. And this one got 1,322,400. Here, when you add this, you'll get appropriation, partners appropriation, partners appropriation. Partners appropriation, let's add this. 763,800 plus 1,161,200. This gives me 1,925,000. The other one is 784,600 plus 1,322,400. This gives me 2,107,000. We bring in share of profit. Share of profit. Share of profits. Share of profits here, we have, who is this? Kefa, 9,911,732. Share of profit, 9,911,732. This 9,911,732. 732. That is Kefa. And then, who is this? Kennedy is 4,955,866. 4,955,866. But before I get the taxable income, there is rental income, other incomes. Other incomes. This guy called Kennedy was receiving income. Was receiving rental income here. We have this is rental income. Rental income for Kefa, 475, 350. So at this point, I can be able now to find taxable income. Taxable income. I've gone in length beyond what the examiner wanted you to fill, so that you understand this one in detail. So we have 1,925,000 plus 9,911,732,000 plus 450, 475, 350. So this guy has a taxable income of 12,312,082. The other person is 2,107,000 plus 4,955,866. This is 7,062,866. That is it. This is what you compute pay for the two partners. And that marks the end of this question. Thanks for watching. We meet in our next video. Goodbye.